It's a mix of companies. I mean, let's start off with Pepsi.
Yes.
And some would argue that maybe the valuation relative to itself is pretty high at this point.
Well, I call it the ironic trade, because if you think about Pepsi, they don't make anything really healthy. And we talk about how millennials want healthier snacks and everything else, and they beat their quarter earnings were very good. They beat estimates, and it's because of Frito-Lay. And who would guess? You think about chips, and you think about things that are very unhealthy as really driving their market right now. And I think if you look at them from a North America standpoint, that's where a lot of their growth is coming from. And they're doing a lot of marketing there, too. So I think that trend is going to continue, and I think it's a trend that no one really expected.
Mm-hmm. What do you think is driving that trend towards crunchies and the ability for consumer staples companies in general to raise price or keep price firm?
Yeah, I think it's hard to do that in this environment, too, but I just think it's that I think Americans have a sweet tooth, and it's something that gets discounted because we have this mirage of that we like health food, and it's actually not true.
Mm-hmm. It's the carbs. It's not necessarily sweet. And if you tried to do the carb-free diet, and when you need a snack and everything that you want that is a snack, you can't have. There's one thing that they tell you can have, and you have three of them. It's like, I'm never having it. The pork rinds. You can't have that. But if you want some kind of toes, Fritos, Cheetos, Tostitos, they're all Pepsi, and eventually you do break down, typically, I think, don't you? If you need a snack. You can't eat meat. And now it's not even going to be meat. Beyond meat. Have you thought of Payne Capital? No pain, no gain. Have you used that as a
that is the name of our radio show, so I appreciate promoting it every Saturday on WABC.
It's obvious.
But do you think that people are always going to have unhealthy chips and sodas and things?
Anything in moderation, though, Andrew.
I mean, I think it's one of those things that's just been unexpected, right? So I think the world kind of thought that, well, in America, we don't eat that way anymore, and it's just untrue. And I think the earnings speak to that, and I think the fact they're going to continue to market to that means it's still a good buy in the short term.
Right. Kale chips.
You know what I've had recently?
No.
That are actually really good. You ever have a Quest bar? You know what a Quest bar is?
Yeah.
Right, okay. No, I know, but Quest is now making potato chips.
Oh. I got to try that then.
They're like,
are they potatoes?
I don't know.
They're beyond potatoes.
They're called protein chips. They're called protein chips, and they taste like potato chips. They're really good. They get barbecue chips. There's
a Quest bar is like a Snickers bar for millennials. It's still pretty unhealthy if you look at all the sugar and everything else.
I think it has stevia in it.
Stevia, exactly. Is stevia really healthy?
Yeah, who knows?
Do you want a chemical sweetener? Anyway, let's move on. This is the mystery chart. JP Morgan.
JP Morgan. Okay, I came on the show last time I talked about JP Morgan when we had the inverted yield curve. Everyone was not feeling very bullish about it, and they still made money on their net interest margin. And I think as the economy continues to pick up, I think interest rates will rise, and that will be great for the stock as well, which is already doing well. So I think banks in general look good here.
Has it proven itself based on the last earnings that it's really above the rest of its peers in terms of execution and the ability to navigate this flat yield curve environment?
Yes, I mean, and the yield curve is, it is flat, but remember, interest rates were hiked 4 times last year. And, banks are a little slow to raise their rates, the way the Fed did, so they're still able to make money in there. And I do think that, again, as the economy picks up this year, if you get a little bit more of a steep yield curve, they're going to make even more money on that. And, the price to earnings right now is just really attractive at 12 times forward earnings. So,
Kinder Morgan's your last pick here for us. Why go pipelines as opposed to an E&P company or an integrated?
I think because they're really dominant in the space of actually owning the pipelines. And as we get more production coming from the U.S., which we're really dominating in that space now, they're going to be one of the ones that has the spare capacity. They have another $5.7 billion in project coming up. And I love the cash flow, right? You're getting a 5% yield. They're going to increase that another 25% next year. And Richard Kinder, who owns the company or owns a large portion of the company, he just bought another 73 million shares since April. So a lot of inside buying as well as a really optimistic view for the company.